Welcome to the Airmere Roundtable. Today's the 13th of July, 2022. I have a special friend, Ed. Ed and I have known each other for many years. Ed's done presentations with me before, and it's always nice to have you back, Ed. So welcome. It's glad to have you here.
Yes, good to be here.
So I guess, Ed, do you want to go through your disclosure and everything?
Yeah, we'll go get this disclosure here. And everything we're talking about is for educational purposes only, but Random Walk is not a broker dealer, not giving any kind of financial advice. Any P&L, that's just strictly hypothetical and all that kind of good stuff. So putting any trades in, make sure you're paper trading, and watch for commission slippage, all that kind of good stuff. So all right, if you want, I could jump right into things here.
Yeah, that's fine.
Okay.
Yeah.
Today we're talking about the importance of verticals. I'm a big butterfly fan, but as you know, butterflies consist of verticals, a long vertical and a short vertical. So kind of go, a little nuts and bolts session that we've done with students, and gave a little background, risk reward, what expiration, how do you pick a long option, short option, expected moves, of course, volatility, like we've been having since the first of the year, all that fun stuff, and then combining the longs and shorts and kind of wrap everything up in a little bit of a bow. So that's going to be kind of our agenda today. And so just like I said, a little bit of a background is, one of the base foundations for a lot of strategy that we do are based upon the vertical spread. And a vertical spread, as you know, consists of one long option and one short option. And the individual legs or strikes are important in many regards. And we kind of use those specific soldiers, so to speak, in our trading strategies to kind of, when you set up a strategy, picking those are very important. But, and like I said, just a normal long call debit spread, we're long a call option, and then we're short a longer strike strike option where we collect some credit. So, and a concept is, by selling that further out of the money option, you can reduce the total debit of the trade. So, and we'll get more into that here in a second. The second thing that we'd like to look at is risk versus reward. And this is typically a calculation of the cost of the vertical versus the width of the spread. A good risk reward gives a trader some edge in playing a directional bias, or if you want to sell premium at a support or resistance level on a particular underlying that you're doing. So, the cost of a trade is kind of just mentioned is the price of whatever you're paying for the long option, and then you get a credit of whatever the short option that you're selling. And so if you take those two, that'll give you the total cost for that particular vertical. The spread width is just simply the strike of the long option minus the strike of the short option. 5 point, 10 point, 20 point, 50 point is what we're looking for. And then our reward is just the spread width minus the cost, and is a basic, back of the napkin calculation. 4-to-1 risk reward is typically what we're looking for. Obviously, the further we go out of the money, the cheaper it gets, but also your probability. So we can't have our cake and eat it too. We have to have a little balance there, and we'll be getting into that as well. Next up is, how much time, and obviously with so many different expirations, and now we're getting into, daily options, and of course got weekly options, of course, quarterly and monthly and all that different expirations that we can pick with, which one is best, so to speak, and best to use that term loosely. We have to keep in mind that the option decay or theta decay increases exponentially, particularly less than 30 days to expiration. So from a strategy standpoint, we consider, if a trade is less than 30 days, that's kind of a short-term type of trade. Medium-term trades are 30 to 45 days to expiration. and any kind of longer term trade is going to be greater than 45 days. So sometimes people like to do broken wing butterflies and 45 days, and that's fine. It's just to whatever your trade setup is, that's what you want to go with. So the next piece, or the first component, obviously, is what long strike do we pick? And the first step in creating that vertical is after we kind of pick the expiration that we think that the underlying is going to go from point A to point B, we got to pick a long strike, and the trader can use the delta of the option to help determine where to get the best bang for the buck, or for the dollar that you're paying, so to speak. And to illustrate this, you can take the, let's see if I can do this to see if this works here. This might work. So the sweet spot of the delta curve is this between the 27 and 27, or 22 to 27 range here. So this is maybe small on your screen, but this is kind of the sweet spot. If you think of this as a ski slope, obviously if we're going uphill, you can't ski uphill, but you can ski downhill. The maximum incline is where we're wanting to go, because if we're going to be bullish and doing a long call spread, we want to get at the base of this curve here. And as we go further and further in the money, the price of that option is going to increase very rapidly to the upside. And obviously we want to go fully in the money at expiration. So that would be is kind of what we're looking at. So that's where kind of starting where we want that sweet spot for that long option, just to kind of look between those 22 and 27 deltas. And that's there we go. And then if we're looking to sell an option, whoops, I just lost the video. There we go.
There we go.
There we go. I got a little too fast with the trigger button there. So we talked about, the sweet spot for the long option is there. And if we're going to be, if you want to sell premium, a lot of times, particularly if you're doing tasty trade strategies, you're selling a 30 delta. So you're selling some nice meaty premium at the 30 delta to collect some premium for the risk that you're taking on. So that's, there we go. So in a side note, as far as when we talked about, selecting whatever strike, and we talked about, the delta here. So this is our column, and then we got our, between our 22 and 27 delta. It's kind of the sweet spot for our longs, but the probability of touching, which is this particular column, is, again, roughly in back of the napkin is 2x the delta. So we're keeping that in mind, particularly, if you're selling a particular strike, even though it may touch it, doesn't mean it's going to expire there. Obviously, if you're doing lower probability trades, you're a little bit closer to the fire. Higher probability trades, you're at the 1 standard deviation, or down here at the 15-16 delta. So you only got a 30 or 32% chance, if your trade, going out worthless if you're trying to sell premium. But here we're doing, a directional play, and our long strike would be here. And just highlighting, the probability of touching it is there, but what we like to do is to, take advantage of that movement that happens in the underlying, and that can obviously go in our favor or it can go against us, and we'll talk about that as well. All right, so in this case here, we got a screen of Apple. This was a few months back, but it's still viable. So just comparing the cost of the long call option in low and high priced indices. We got Apple here on the left, and we got Amazon here because it's underneath my little bar here. And we can clearly see, and this is obviously before Amazon did its split, but if we wanted to buy a single option in Amazon, take for example, let's look at the 3300 strike. I mean, you're looking at a pretty hefty price of almost $8,200 just to buy that one strike. And that's slightly out of the money versus, something at Apple that's, a little bit out of the money, and then let's say 170, that's $230. So just from a flat, purchasing standpoint, you can see it's a pretty big magnitude because it's a bigger index, right? It's a $3,200 index. It's a real big instrument. Apple's lower priced. People like to buy it because it's more affordable. But debit spreads you can still do in bigger priced underlines without having to pay this cost here. We don't want to pay that kind of money. That's a little bit expensive, and then also implied volatility, which we're going to talk about here as well. So let's clear that. And so the next step is, after we've picked our long strike, is what short, what short strike. And obviously we can go one strike further out, we can go 2 strikes, 3 strikes. But we're picking that short option to sell, and this is what's giving you credit to kind of reduce the initial debit spread for the particular trade. And many times we go further out of the money. And some just general guidelines we like doing is the try to keep it 50 cents or more credit, and we typically use just a basic risk reward as guidance. As long as it's 4 to 1 or better, the short strike selection should be adequate. But like I said, we can go further out of the money, it's going to be cheaper, but it's a lower probability trade. So the balancing act of a good risk reward versus that probability is kind of what the trader is faced with. And we're trying to get the trade on the winning side and then get it across the goal line there. So with that, the next thing is, after you've picked your long and you picked your short strike, is the expected move. And as you know, with the market, coming off, 20%, 30% declines from first of the year, implied volatility is popped up, and that's increasing the expected move. It's increasing the bid-ask spreads. So stick with verticals is my motto. But the expected move is gauged on how much the underlying will move based upon the implied volatility. Now you can use the brokerage platform calculation that's built into it. I know Toss and your Tastyworks, they got some slightly different calculations. You can get a little bit more technical using the expected move calculation, where it takes into account the actual implied volatility on the call side or on the put side. So those values will be different. The call implied volatility at the money versus the put at the call implied volatility will be different. So you can calculate for yourself if you'd like. In this case here, we're looking at Toss, and here they do as a term as a percentages, or you can do the plus or minus 118, whatever expiration you might be interested in. That is one easy way to kind of look at it. If you're just trying to get a ballpark idea, based upon, okay, IV rank or implied volatility is X, I can know the underlying can move 100 points, 200 points in the underlying. So here, I just pulled up Apple, for example. Whoops, I'll go to Amazon in a second. Up here, I just did a little Excel spreadsheet just showing the price and the implied volatility. And then we've gone out 34 days, and you can see expected move. Now, obviously, this is a smaller move. It's a smaller underline. It's 10 cents difference. And it's like, okay, I get it. But that could be different depending on the underlying. But you can see it. You can put it in your chart there, and you can look at the implied volatility for your first out of the money 24.2, and then we got our 27.36. So again, just kind of gauge where you think the underlying is going to be. I love butterflies, and I'm trying to not anticipate, but saying, okay, based upon where I think the chart is, with technicals, that type of thing, where can I construct or build a butterfly around that particular area? So but likewise, if we did the same thing in Amazon, similar case here, where you can see in this case it is a larger animal. This is obviously, like I said before, the split, but you get 341 on the put side, and then 348 on the call side. So little bigger moves, and again, just to gauge, it's just an instrument. Don't get worked up about being off by 2 points or whatever. Nothing's going to be 100%, but we're just trying to get it, like I said, a ballpark where we think that underlying is going to be, so we can have that vertical kind of work in our favor. So next up, we talk about the importance of volatility, and obviously in this crazy market that we have, or up or down and sideways, buying spreads helps negate that impact of volatility on both the long and short options. If the IV rank is in the lower 1/3 or 1/4 of its rank, and then buying single options is optimal. But with these wild moves that we're having, sticking with verticals is probably going to be your best friend here for until this market decides it wants to settle down. But I don't think that's going to happen anytime soon. So earnings events, again, sometimes beginners want to just buy that single option the day of earnings, and then they get creamed the next day because their call that was going to make all this money, implied volatility, just bled out of it, and you ended up losing money. So like I said, stick with the vertical, stick with the butterflies to litigate that impact, or know the construction of your butterfly to take advantage of that decrease in implied volatility if that's what you're looking for. So in this case here, I just did a simple, this is a simple little slide here, and this is just showing when you have very high implied volatility. So in this case, the 50%, this blue line here, you can see it's kind of getting flatter and flatter as a pancake, right? And then if implied volatility gets really low, then it shrinks up. It gets very skinny, and you see this in the price of your options. They drop off pretty dramatically, where you're starting to go out of the money in either direction, and the price of the option is decreasing, and you're going to see that in reduced credit when you try to sell a credit spread. But with the higher implied volatility, you're also noticing that you can go further out and you can get some premium, and that's just because the uncertainty of this market is giving you a little bit more juice. Now, at the same time that we want to receive, if you're selling credit spreads, for example, you're looking to get some juicy premiums. But you're probably noticing that in order to get the full premium out of it, you're almost going closer and closer, almost to the day of expiration, to get all that premium out. It's not bleeding out as quickly as it did, let's say, a year ago, and so we got to pay attention to it. So again, so like some people like strawberry ice cream, some people like chocolate. But that higher implied volatility kind of comes in your favor with the market kind of going like it is. If you got a good risk reward vertical, and you got the market that's kind of zooming higher, zooming lower, you can take advantage of that vertical, whether you're buying or selling it, to hopefully collect some profits in that. So. And just kind of further drill the point, is when the implied volatility is high, you're expecting the IV to decline. You can go further out in time, kind of gives you more negative vega. So when the implied volatility is really high, you want to sell as much negative vega as you can, and because eventually vega will go to zero at expiration, but you're trying to take advantage of that decrease in implied volatility. Shorter expirations have less negative vega than some of the further out in time trades. So again, it's a little seesaw between risk reward and where the probability is going to be in the trade. So here we're going to kind of combine the longs and shorts. We talked about the basic combination of the long strike and the short strike for a long vertical. We can take it one step further. If we do a short vertical and we combine the long vertical with the short vertical, we can create a butterfly. We can create condors. We can create all kinds of different flavors of butterflies. Broken wing being one of the more popular ones, and then some of the condor cousins, regular condors, unbalanced condors, ratio condors, all that kind of good stuff. And that's kind of what I was kind of, as far as the takeaway that I wanted to kind of point out today. And this is an Excel dashboard product that I sell. And we worked on this a few years back, but it helps find butterflies relatively quickly. In this case, I'm looking at the cues, and I'm looking at, I'm looking at only at 5-point strikes. I mean, they could be 1-point strikes as well, but what this is showing me is what we call Venus flies, and I can see the price of these butterflies, and these are different width combinations here. And here's a 290, 305, 315, what we call Venus fly, which I'll show you here in a second, with what we call a short ratio of 14.4, and then gives me kind of a risk reward based on that. So let me kind of walk through some of that. And you'll notice that some of these are, some have a blue outline and then they start fading out here. You don't see it here. And that's because the short ratio is underneath 10%. And what is all that? And so I'm going to kind of walk you through some of that. And let's so in this case, I got that same butterfly that we just looked at. You basically click on it, you can paste it straight into toss, and it automatically, you don't have to sit there and pick your expiration and strikes. It automatically kind of puts it in there for you. But this is what I call a good Venus butterfly. And if you've not heard the term Venus butterfly, I do have a PDF document, and I got a slide here at the end that you can email. I'll be happy to give it to you. It's free. The Venus fly is, I consider this a directional butterfly. You can see, in this case, we got a positive 68 deltas. So, normal butterfly, you're pretty flat. You got equal lengths, or you get the outer wing stretch a little bit further. So it's used from a directional bias. So and many times a Venus fly, I can get a little bit closer to at the money for the same money as I can for a vertical. The vertical may be further out here, but I'm getting ahead of myself. But so the Venus fly is simply, a broken wing butterfly is when you pull this outside wing lower. So I pull this down here, then you'd have a broken wing butterfly. But if I lift it up and pull it up such that if we go completely through the butterfly, I have profit zones here. So I still make money. Whereas a broken wing butterfly, you're not going to be happy. So that's just clarifying what a Venus butterfly is. The second term I'm throwing out here is what we call a short ratio. Why is this important? Well, a short ratio, I say when you construct a butterfly, whatever the butterfly is, it could be broken wing, it could be 1-3-2s, symmetrical butterflies, doesn't matter. Whatever the short vertical is in the butterfly. So this is the short vertical in this particular butterfly. What we do is these two trades, I broke into the long component and then the short, just so we can kind of see it. So if I take 523 and minus 143, I'm going to get $3.80. But you can see I'm collecting $1.43 on the short vertical. And the width of it is the difference between these two strikes. So 315 minus 305 is 10. So that's where we get the $10. And if you take the $1.43 divided by 10, you get 14.3. Now, the general guideline that we go by is, if it's less than 10%, you're better off doing a vertical. And I'll show that here in a second. But that, we're constructing a trade because, in this case, the cues, we feel bullish. We think it's going to go higher. So for every $1 move we can go higher, we make $68. And then obviously we get inside the butterfly. And then this is, it's like a three-week trade. I did this, I think, last night. So we use this from a directional bias. So we're trying to minimize capital that we're spending. But again, we're just kind of showing an illustration of what this short ratio is, why is it important, and kind of walking through how we want to deal with that particular scenario. So let me clear that. If we take another example, this is what I call a bad Venus butterfly. This one is I say bad, but it's not preferred because the short ratio here is 52 cents. So now I'm only getting 5.2% on the short vertical here. So a different scenario here. I'm not getting as much credit. And this is a $2.21 butterfly. I'm paying $2.73 for this long, and I'm collecting 52 cents on the short vertical here. Now, many of you probably hear the general guideline that any kind of you're selling credit spreads, a third of the width is a general principle. And I'm in the same camp, trying to collect at least a third is preferable. But in the construction of a butterfly, I'm happy with 10% or more. But anything less than that is not really an ideal scenario. Let me further illustrate that and go. Sometimes, like I said, I'm more a visual trader, so seeing it kind of makes more sense. So here, I've kind of overlaid this with a plain vertical. So the red line here is this plain vertical by itself. And that vertical, the 300, 315, is the same construction of the Venus butterfly that we just looked at, which is this tan line. So this tan line and this short component here, that 52 cents, yeah, I'm collecting 52 cents, but this totally wipes out the profit in the Venus butterfly. So you're not really, you're giving up a lot of potential profit. This is what almost a $6,000 vertical that we have here. And if you're doing the Venus, I can severely trim that almost down to 1,000. So I'm giving up almost $5,000, and that makes sense because this is pretend, for example, if I say we got 50 cents for this. So just from a plain credit spread standpoint, if I sell this spread for 50 cents, it's a 10-point spread. What's my risk? It's the difference between the strikes, which is 10, minus the 50 cents. I'm on the hook for $9.50 per contract, and I'm doing this 5 times. So that's why this profit area goes bye-bye. Obviously, we want to get more, but that 10% guideline is kind of what we like to do. Now, if we go back, I get this question a lot is, okay, what do we do once the Venus fly is on? Oops. So let's pretend, for example, that we get this trade on. We don't usually what I call pay retail for the trade. It's $3.80, but that's another discussion. But if it goes in our favor, you could just simply take the trade off if you'd like. We could sell another 305, 315 strike against this. If we do that, obviously we're going to collect more than $1.43. If I can get here is a 10-point spread. If I can get $5 for it, and that clearly is going to pay for the trade. And now I have basically almost a 132 type of butterfly. Where now I've eliminated all the risk here, and now I still have a profit zone. And whoops. And what I'm trying to, if I do trade it into a 132, depending on how much credit I receive, is going to, depend on how much margin that we're going to tie up here on the upside. But that also makes sense, right? Because if I collect, let's say $5, that $5 that I'm collecting, yeah, I'm going to pay $3.80 or collect the $5 minus the $3.80. It's going to leave me $1.20 credit on the upside, but also the $5 I'm collecting on these other 5 spreads times 5 is $2,500 in potential margin that I'm going to have up here on the upside. So it's a trade-off, but depending on when the underlying is, and if you think, hey, okay, we got some good resistance here at 310, we can do that. The other thing that we do a lot of is what we call a outer stack fly, where we can add a broken wing butterfly to this such that, oops, that we can create something like that. And that's also on the glossary. I call it a butterfly glossary terminology on the Venus butterfly, the outer inner stacked butterflies, that type of thing. But we can add a butterfly here to lock in profits. And also we can look at adding an inner stack fly, because they made the cues, they decide they're going to take a turn to the south and we start running away. We can instead of adding a butterfly on the outside, which we do O, we can add a butterfly on the inside and collect some premium. So that'd be inside, outside, to collect some premium and collect some premium, excuse me, and get this trade up above zero. So a lot of us, or I say many of the times, we're looking for good risk rewards on the butterflies, but we're also, that's kind of like the first stage. I mean, it's like you start the race, and it's 5K race. You got to go the whole 5,000, to complete the race. And this is, just starting the race. And obviously you got to wait till expiration to get in there. But we're looking as the underlying moves up and down, is there ways that we can take risk out of the trade? Can we buy back some shorts, or can we add a butterfly without injecting a lot of capital, such that we're trying to get this entire trade so it's above zero? And we've done that. Not all the time, but if I can get this butterfly all above zero, life is good. Or in this case, if you got a Venus butterfly here and he starts going higher, you may want to say, okay, I think it's reached its high point. You may want to put a small put Berkeley butterfly, collect a couple bucks, and that'll help push this side up. So a number of adjustments and stuff that we do. It's that we kind of do a lot of, but like I said, the verticals is kind of our bread and butter, and then finding butterflies that match the underline of what we're trying to do. So that's kind of what we look at. So any questions on that? I know I've thrown a lot out there. I'm trying to see if where's the chat window here?
I don't see any.
Okay, so everyone's understanding it. Oh, that's good.
We got a good crew here.
Yeah. So so that is what we have. Let's see here. That's the bad. There's the vertical. And just our little spiel is our class is we call options and action class. We have a webinar every week. We do a monthly education session. We have a chat room, and then starting in August, we're going to start doing some trading a live session. We did one right after 4th of July. A lot of students liked it, so we're going to start doing some of that in August, probably on a weekly basis. Just the mindset of why we're getting into a trade, what the technicals are showing us. We do use Keltner channels, we use fibs. It just thought process as why we're putting on a trade. We do send out text alerts. The chat room is usually the first to know. Text alerts, you may have a minute or two, lag. $60 a month. And then the butterfly glossary, if you want to email me, happy to send a PDF talking about the different butterfly types, pregnant butterflies, 132s, all that kind of good stuff is there. And then if you're interested in the dashboard, that's a link to the dashboard. You can play with it. So, but it was a tool we developed a couple of years back just to help save time. A lot of students, they're working full time, and it just allows them to instantly find butterflies that kind of fit the criteria that we're looking for. And they click on the spreadsheet, click and toss, hit submit, and they're done. So just, as you know, when you construct butterflies, you have to, kind of play with them. It takes time, but, like I said, if the market's moving fast, it's a nice little tool to have. So, but that's all I had, just a little splurb verticals and why we think they're important. And obviously they're very important to building butterflies. So GK say, at what point do you adjust the downside? So good question. And that so every other week we flip between risk reversals and what we call a pregnant butterfly strategy. And that's basically I'm trying to keep it as simple as I can here. Let's say in the Qs, this is obviously a bullish trade. We want it to go to the upside. In a pregnant butterfly type of trade, this is on the call side, obviously. We would put on a seatbelt, which would be simply a very good risk reward put vertical on the downside. So if it goes to the downside, we can make money on this vertical. But there's other things that we can do with the vertical. Obviously, if I buy a 4-to-1 put vertical here on the downside, we can make money. But if it starts, going in the direction that we want, we're losing money off this vertical, but we will flip this vertical such that I add a butterfly and create a Venus butterfly that's closer to at the money for very little money. Sometimes we do this for credit, depending on the expiration, but that's what we call a pregnant butterfly strategy. So we kind of use that. So sometimes we can double dip, we can make some money here. And then if it goes to the upside, we can sell, this first leg here for credit. But our our mission, so to speak, is to get this risk graph up above zero as quickly as possible. And obviously, the only thing that could really hurt us is if we kind of just sit here for 30 days. But we're banking on some kind of move to the upside and sell some premium, or if we move to the downside, we got a vertical, or we can flip it. And then we can also, a little bit simpler examples, if we'd had a long put vertical here on the downside and it does go in our favor, we'll attach a broken wing butterfly to it for a credit. Because why would we want to do that? Oops, I'm going off the screen here. Clear this out here. Let's do this. So I got to put, and I'm adding. So if we go to the downside, if this is a 4-to-1 put spread, oops. If we go to the downside, so this is only for what we call plan D in our pregnant butterfly side. But if we go to the downside, I'm looking to add a broken wing butterfly for a large credit. That goes in our favor from not only from a delta perspective. This is a long put spread. Now this is in addition to the call side. We still have the call side on. Now, if we're bearish, we just flip everything. We'd have a Venus put fly on the downside, and then we'd have a call spread to the upside. Because don't know about you, I can't pick the direction. If we're lucky, we get it. But in this scenario, if we go down, we're benefiting from deltas because this is a negative delta trade. But also, as you go down, implied volatility goes up. And you also know the put vol skew expands. So you're taking advantage of doing a broken wing butterfly for a credit, because as the vol skew expands, you're getting more credit for this short vertical here. So we can we get $3-4 out of this thing, and instantly bring things to the upside.
And I pasted a link in for the pregnant butterfly presentation you did about 4 years ago.
Mm-hmm.
So people have more questions about that.
Yep. And that's why we kind of do it every other week, because if it's new to you, it's like, okay, what we're doing. But yeah, we got guidelines and all that kind of good stuff. And we do, examples and everything. So that way you kind of follow along and you can see what adjustments that we want to do and stuff. So, but yeah, that's, if we get a large credit here, sometimes, this one adjustment here that we're doing will raise everything up above zero. So now you basically got a free, I say free, but you got a risk, a butterfly on the upside. In worst case scenario, you break even, or we have a credit here. So how does the Excel dashboard get the required data? Does it depend on TOS running, or does it come with operator data license? It uses the RTD TOS interface, so you got to have a TOS account. It just uses that and just feeds it. So yeah, and when during market hours, yeah, it'll be live. So, yep. A good question though. So,
and to get the Excel sheet, do you do the dashboard training? I guess that would come with the sheet, I assume.
Yeah. So I think the way we package it, you get the Excel spreadsheet, and you get like a 2-hour video on all the ins and outs of how to use that dashboard. Every different component, every different nuance to it, everything. So it's just not only for the trade, but strictly on how to use the spreadsheet. So,
right.
Yeah. But we'll use it sometimes in class. On Thursday nights, we'll use that. I can go in here manually and try to find a trade setup that we might like, but I might pull up the dashboard and just to kind of confirm if that's, say the optimal, but is that kind of find a better butterfly. So like when you go fishing, you're looking for the big fish, we're trying to find the best bang for the buck, and here we're trying to find the best butterfly.
Could you maybe just show a quick example of using the Excel tool?
Yeah, let me see if I can pull it up.
Nothing like a live demo, right?
Yep, a live demo does wonders, don't it? Let's see here. All right, so now there we go.
Nice colors, by the way. That's kind of cool.
Yeah, kind of conditional.
Yeah.
So here you can put your ticker symbol in here. So I did SPX, and then you can pick your expiration. And here I did 10 points per row, I guess. And then here, and I'm just hovering my mouse so you can see, I'm just hovering, you can see it's automatically showing you what that short ratio that we're looking at. It also does a blue outline. But if I go further out here, you notice that, some of these get a little bit still high with the implied volatility with the options that we got. But it gives me a ballpark idea. And then I also got the deltas here, so I can kind of see if I want to position it between a 22 or 27 delta. Let's pick this 470 here, for example. I think got Mr. Toss open. That's, and it's some other screen here. And this is an existing trade, but we'll put it up in here. So I just hit paste, and then I'm just going to do analyze, bring it back down, and let me just turn series off here. So that's the Venus Fight. You just unlock it, and there's the 470 that we just looked at on the spreadsheet. So that these prices will update in real time. And instead of going to the, playing with the different strikes, you can just see it, and it's like, okay, I want to take that, pull it up, and then you can just right click, submit the order. So that'd be
Nice.
One way we can do it. So yeah, you can change it, different ticker symbols that you want, I think into some NVIDIA trades, and I could pick the different strikes. So I think we got position in NVIDIA, and it's obviously 10-point strikes. I can change the strike width here to instead of 10-point, I can do 5-point or 1-point, whatever it may be. But the other sections in here, we do have simple spreads. Oops, let me go back here. And I think there's an expiration for Mr. NVIDIA. Got the 15th. What is a Friday? Let's pick one. Should be what, 22nd? Yeah, we got 1/22. There's got 5-point strikes. So these are verticals. It's, again, looking for good risk rewards. We got the broken wing. If you're in the broken wings, we got broken wings here. On the money flies are the Venus flies that we just looked at. We can also do, you want something Mr. Russell, and it's like, I want to do a broken wing butterfly. We can quickly go out there. I'll go out again, just pick a month. So 1, 2, 3, 19th. And here you can see the blue you see how it kind of tapers off here because the short ratio is 1.5%. So you can see based upon the premium here, it drives up kind of quickly, but you can pick, do I want a 215? Do I want a $1.60? And what I'm looking at here is the higher I go up here, the bigger the butterfly. These are the smallest ones, which makes sense because you got the smallest. But if I go here, let's say, 55 cents, that's all go in there.
And as we get a question, does the dashboard let you build custom spreads and ratios?
Kind of. The tutorial kind of goes in it. You can play with a couple parameters in there. But I try to keep it basic because obviously I didn't want to put the whole kitchen sink in there. So there's a little 60-cent debit one that we just did off the spreadsheet. So Within 10 seconds there, or 30 seconds, we found a very quick butterfly. And then
What do
we
you
would
what do you
take,
do on the spreadsheet to get that in the clipboard? I think I missed that.
you just click on the cell,
Oh, okay. Easy
you just
enough.
click on the price. And then we would refine this because sometimes you want to get it for a credit, and so we know as students know that we can, if you want more credit, we would just make the butterfly smaller. So we just pull in the legs, maybe a strike. Let's see, 75, of course, you get 10 points, or you can pull the outer wing closer. But you can see I just pulled it in 10 points to either side, and now you got your little credit. So with that, quick a turn, you can do some, pretty nice. I mean, this is a nice little broken wing butterfly, potential 15K, risking 4,600. So a 3-to-1 broken wing butterfly with positive 17 delta. So.
Excellent.
Yeah. So yeah, it's a nice little time saver. If you're looking at a bunch of different underlines and it's like, okay, I think it's going to move, it's going to move 66 points or whatever it may be, we can come in here and try to find a butterfly pretty quickly. Yep. But that is, that's all I got.
It looks like we're out of questions too. So I guess we can wrap it up. So many thanks for coming, Ed. And I'll put all these links in the at the recording. And I guess your email address too, if people want that butterfly glossary.
Yep.
And anything else you'd like to add? Maybe specials or something?
Yeah, I think we do like a 2-week trial, so happy to do that. So, but yeah, I'm usually in the trading room. I'm usually guilty of being in at all hours. So sometimes I might post something late at night, or the other thing I do is I'll post the morning gaps. Stocks that are gapping up in the pre-market. I post that in the chat room. Some people like to play the gaps on those. And we do. We're getting a little bit of futures. We're doing some future type classes. We just did a summer school series, but we got 5 years of archives, video archives that you can watch me for 5 years. So I mean, that's enough to put anyone to sleep. But lots of good stuff in there.
Well, if you want to come back in the future and talk about any other stuff you're doing, you're always welcome, Ed. Just let me know.
All right, sure. Yeah, no problem. Do it.
All right.
Get my vacation time in. So.
There you go. Yeah, get all relaxed first, right?
Exactly.
No stress trading.
Yeah, that's why we do this, right? You make money to use it for something. So
absolutely. All right, Ed. Well, thanks very much. Sure. Thanks everyone, and we'll see you next time.
All right. Thank you.
Yep. Bye.
Bye.